Welcome back. Today we're reviewing a detailed analysis on Milestone Pharmaceuticals, or MIST. It's following that big FDA approval for Cardamist, arguing for a massive stock price move.
Right, based on a financial unlock and what they're calling a market dislocation. It makes a strong case, but there's a dilemma right at the surface we should probably tackle first.
Let's jump right in. The choice of highly sensational and aggressive language, while it's perfect for a video title like "Alarm! MIST stock could explode on Monday," it really risks undermining the objective credibility of the analysis report itself.
I see that. It's a very high conviction approach.
Totally. You see terms like explode, calling the approval the holy grail, and predicting a violent gap up at Monday's open.
Yeah, that's powerful stuff. It absolutely hooks a certain kind of trader, the short-term momentum crowd.
Exactly. But then the analysis pivots to this really sophisticated, deep financial and clinical data. So the weakness here is that the tone it clashes with the substance.
It creates a kind of trust gap for a more, let's say, measured or institutional reader.
I do wonder, though, are we sure that's not the point? Maybe they're explicitly targeting that segment of the market that only responds to that kind of hype.
That's a fair challenge. If the goal is just sheer momentum, then maybe they've nailed it.
But if the goal is to produce something that can, influence more sophisticated capital or stand up to real financial scrutiny, then this rhetorical intensity, it comes at the cost of analytical authority.
I think the analysis is just too strong to be limited to that momentum audience. The data breakdown, the valuation modeling, it deserves a broader platform.
I agree. So my suggestion here is that the report should really moderate its rhetorical intensity, especially in the key sections like the executive summary and the conclusion.
To appeal to a more sophisticated reader who values measured analysis. You don't want them dismissing the excellent fundamental insights before they even get past the first page, just because it sounds like a
pump piece. Exactly.
So how do we do that? How do we keep that immense conviction? Because the data absolutely supports a big move, but without sacrificing the perceived objectivity.
You use precision. Use financial language instead of hyperbole to get that urgency across. The weakness isn't the prediction, it's the phrasing.
Okay, so give me an example.
Instead of a violent gap up at Monday's open, you could say something like, a significant positive repricing event at Monday's open.
Or maybe a sharp reversal of the prior week's fear-based selling?
Yes, it's just as bullish, but it speaks with the authority of someone who understands market mechanics, not just hype.
Right. And what about that section title, The Explosion Thesis? Sounds a bit speculative.
It does. You could easily change that to something like the rapid repricing thesis or even post-approval momentum factors.
That small shift in vocabulary, it just completely changes the feel. It strengthens the report's authority.
It makes the data do the heavy lifting, not the enthusiasm. And it tells a sophisticated reader that you know the difference between noise and signal, which is invaluable in this space.
Okay, that makes sense. It aligns the tone with the depth of the data. So let's move to the next point, which is about that new risk landscape.
While the report brilliantly eliminates the bear case clinical risk, it then jumps directly to aggressive price targets without providing enough supporting detail on the identified execution risk that now defines this new commercial stage.
This is where the rubber meets the road, right? The science is done. Now comes the messy reality of business.
Precisely. The goalposts for MIST have moved entirely. The report correctly identifies that status shift from clinical stage high risk to commercial stage execution risk. That's a great observation.
But then
the following sections focus almost entirely on the trading dynamics. The Friday price drop, the short squeeze potential. Instead of the actual commercial logistics, you need to get to that projected 100 million plus in peak revenue. Exactly. We know the product is supposed to be available Q1 2026, but the actual strategy for getting it from a press release into a patient's hands it's just absent.
is there a risk there? By focusing only on the short-term trade, it feels like it might be overlooking the very steps needed to justify the long-term price target.
I think so. The analysis acknowledges the new risk execution, but it doesn't do anything to mitigate it by laying out a credible strategy. And that omission, it really weakens the conviction in those higher price targets.
I agree. The weakness is this analytical gap, this missing commercial bridge. The science is finished, but the business is just getting started.
And that's a whole different ballgame. It's much less sexy to write about than a short squeeze, I get it, but it's what actually determines long-term profitability.
So the suggestion is to significantly build out that commercial timeline section. It needs specific, actionable details that actually support the revenue forecast.
Yes, it needs to establish how the company will capture market share, how they'll overcome the hurdles of a 2026 launch. That revenue number is the bedrock of the whole $4.50 to $5 price target.
Right. It's about connecting the approval to the profitability. And the report does mention the core value prop.
It does. It highlights that the drug solves the problem of expensive and stressful ER visits. That's a huge potential cost saving for the whole healthcare system.
An undeniable value proposition. But we need to connect that high-level idea to what the company is actually going to do on the ground.
For example, the analysis can add specifics on pricing strategy. Is Cardamis going to be priced competitively to get rapid insurance adoption, or are they going for a premium price point right away?
That choice alone drastically changes the revenue timeline.
And what about distribution? We need to see some details on their plans there. Are they going to use specialty pharmacies? How big is the initial sales force going to be? How are they targeting the cardiologists who will actually write the prescriptions?
And don't forget the logistical nightmares. PBM negotiations, cold chain storage, those things can kill a great biotech story after approval. Addressing them shows the analysis gets the complexity here.
And this circles back to the most critical piece. How does that newly unlocked cash actually facilitate this commercial ramp-up?
The report mentions the $75 million cash injection, which is foundational.
It is. So the analysis needs to explain how MIST plans to deploy that capital, not just for runway, but specifically to fund the marketing, the sales force, the distribution contracts needed for that Q1 2026 launch.
By addressing those execution risks head-on and showing how the $75 million solves them, the whole report becomes so much more robust. It anchors the price target in actual business strategy, not just
trading dynamics.
Exactly. Okay, that's very clear. It moves the analysis from an investment thesis to more of a true business diligence document. But there's one more structural issue with how that cash injection is presented.
The immediate financial catalyst, that $75 million royalty payment unlocked by the approval, is presented as a critical event, but it's not fully integrated as the primary driver of the fundamental stock repricing.
That's a fascinating point. For a company like this, at this stage, a $75 million non-dilutive cash unlock? I mean, that's seismic. It changes everything on the balance sheet. It's structural.
For sure. And the analysis correctly identifies that this payment removes the burn rate worries and eliminates the need for an immediate dilutive stock offering, which is fundamentally huge.
It is, but
But
the explosion thesis conclusion, the thing that's supposed to justify the big price jump, it relies mainly on technical factors, short squeeze potential, gap fill.
rather than formally quantifying and prioritizing the fundamental impact of that cap. Yes, it's treated as an important factor, but not the anchor. It's not presented as the thing that sets the new floor for the valuation.
So that's a structural weakness. The strongest, most permanent fundamental point is being overshadowed by technical indicators that are, by their very nature, temporary.
Right. Relying too heavily on a gap fill is risky because the market might not respect that signal unless the fundamentals, like that cash injection, are anchoring the new floor.
The goal of this analysis should be to create conviction that lasts past Monday morning, not just Monday's opening bell.
My suggestion here is to restructure the whole thesis. Emphasize the immediate balance sheet improvement as the fundamental floor for the new valuation. Then, you can use the technical factors as accelerants, not the primary cause.
So the technicals provide the velocity, but the cash provides the magnitude. That makes sense. It strengthens the report against any pushback that a short squeeze is just temporary.
And that $75 million cash infusion is the permanent change. That's the foundation.
So we need to flip the narrative. Instead of the cash just being a nice buffer, it needs to be the primary valuation driver. How do we make that connection explicit in the report?
I think you have to recommend quantifying the effect of the reduced dilution risk, right down to the per-share level. That's critical.
Okay, so even a back-of-the-envelope calculation showing how this postpones a potential $50 million dilution event and what that means for the share count.
Yes, that would strengthen the argument immensely. The analysis needs to formally and explicitly connect the dots between cash shifting from burn rate worries to $75 million payment unlocked within the valuation model itself. That's what professional investors look for.
How risks are permanently removed.
The analysis should state very clearly that the $75 million in funding fundamentally de-risks the company independent of trading volume or short interest.
So you anchor the move towards that $5 target on solid financial footing, and then the technical squeeze potential becomes...
It becomes the icing on the cake. It's the guaranteed trigger for the explosive move, rather than being the reason for the move itself. That structural clarity just provides so much more analytical rigor.
That is excellent. It shifts the focus from short-term momentum to long-term financial security.